Hello, I'm Deborah Trowell, the founder of Elevation Wealth Partners, and this is our November market update. With me today is Peter Hardy of American Century Investments. He's a vice president and senior client portfolio manager at the firm. He's been with them since 2008 and is based in Kansas City, Missouri. Welcome, Peter.
Thank you, Deborah, and appreciate the opportunity to be here. Um, just a little bit about the mid-cap value team that I work for. We're known for our win by not losing, quality, value, dividend yield, but low risk approach. And so that'll encapsulate or frame up a lot of my comments about what we see in the market and the opportunities today. But great to be here.
Great. And I am so glad you're here because here we are in the last few weeks of the year, and it's actually been a good year in the markets. But our investors have really been fearful all along the way here. So, can you start off by just telling us a little bit about that?
Yeah, I think investors have good reason to be somewhat fearful of where equity markets are trading. We've seen a market rally in the face of a lot of risks or concerns thus far this year. And I would say, broadly, the stock market, large cap stocks are up about 15, large cap growth, 25%, mid cap stocks up about 10% on the year. But we've had a market sell-off in the first quarter, really related to concerns about AI and tariffs. And the worst case of tariffs was removed after Liberation Day. Effective tariff rates went from 2 to 17%, and yet the market is reaching all-time highs again in the face of what could be issues associated with tariffs. On top of that, the average consumer is feeling the impacts of inflation with rising prices, and we've seen deterioration in the low-end consumer, meaning more people are unemployed, inflation is impacting spending, and so there's a lot of risks in the market. In that environment, we're seeing high valuations of stocks, especially in large cap growth, and then underperformance of low risk areas of the market like healthcare and consumer staples food company stocks.
Yeah. So the Fed is trying to navigate through all of this. They have a big job to do with their policy decisions. So say a little bit more about that risk. And, we've had some rate cutting going on.
Yeah, I think what we're seeing are two issues with the Fed. The first is, as I mentioned previously, inflation has not really gotten to the Fed's 2% level. So the Fed wants inflation prices to rise only at 2%. And prices have continued to rise roughly 2.7 to 3%. So the inflation issue has not been solved. On the other side, we have seen deterioration in employment and weakening consumer spending. So with that in mind, despite inflation not being as low as the Fed wants, we've seen a reduction in interest rates. The market has reacted as if that reduction in interest rates is good, meaning, okay, lower interest rates helps equity values, makes stocks go up. But a lot of times lower interest rates occur because the economy isn't doing well. And when that happens, what that means is companies don't make as much money. They make less money than they were anticipating. And that can be bad for stocks. So historically, what you've seen is interest rates coming down aren't necessarily good for the stock market. They can be good, but they can be bad.
Yeah. So on top of all of this, we are just coming to the end of this extended government shutdown. How does that play into all of this?
Well, it's kind of funny. The shutdown is now ending. The market really didn't sell off because of the government shutdown, and yet it's rallying this week based on the shutdown ending. There are a lot of negatives associated with the shutdown in terms of spending by federal employees and potentially some employees getting laid off or not getting their checks paid in arrears. So that could be a negative. The reopening is a positive, but I would say one of the impacts of this is the belief that the US government is one of the most sound credits. They have the best ability to pay back the money they borrow over time. And the more we go into shutdowns and the more we have issues associated with paying our debts, hitting a debt ceiling limit and all of those things, that's what resulted in the shutdown. The more that impacts the belief that the US government is a sound credit and could cause interest rates to rise, cause yields on treasuries to rise while interest rates are falling.
So amongst all of this, you and your team have to figure out what companies to invest in for your mutual funds that we use. So tell me a little bit about how that goes.
Well, so we have a 30-year process that we've utilized over time. And we identified companies that we call high quality. That's become an overused term, but it just means they're better businesses that make more money, they're more stable, and they have lower degrees of debt. We do that under the belief that these businesses outperform over time, not all the time, but outperform over time with much lower risk. And then we buy them while they're cheap. So we're a value investor. What you've seen in the current market environment, we've talked about the market rallying in the face of some of these risks. That risk acceptance has shown up in a preference for growth and a preference for themes related to, say, artificial intelligence. So stocks in the technology sector have seen strong returns, are also seeing high valuations. As a low risk quality investor, we also seek dividend yield. So we want to get money in our pockets when we're investing in these companies. We're finding attractive opportunities in kind of areas of the market where we see greater stability, like healthcare companies. People need to replace or utilize drugs or replace their knees and hips, regardless of what's going on in the economic cycle. And we're seeing compelling opportunities in either drug companies on the large side or in the mid-side medical device companies. My mother, in spite of not wanting to go to a hospital during COVID, just got her knee replaced. Zimmer is the largest provider of hip and knee replacements. And that's the type of company we're investing in. They're very cheap because of concerns, but we think those concerns are unwarranted.
Yeah, and so we have a lot of focus on large companies all the time. Those are the ones in the headlines in the news. And now you're mentioning these mid-sized companies. So what sort of size are they? And can you give me some more examples of that?
Yeah, so they use a term called market capitalization, which is just how much the value of all the underlying stock in a company is worth. So if you look at the biggest companies, NVIDIA and Microsoft are worth $4 to $5 trillion. That's a lot. That's a big market cap. Typically for mid cap, and I may show my age, when I first started in the business, mid cap was 1 to 5 billion. Now it's 4 to 50 billion. But there's a lot of very good companies in the mid cap area that we find are very high quality. If you think about it, maybe in consumer staples, we mentioned Zimmer in healthcare, but maybe in consumer staples, a company like Kimberly-Clark, they make tissue paper, toilet paper, feminine hygiene products. Those type of products are utilized regardless of the economic cycle. So you don't necessarily need a new cell phone and a new $1,000 Apple handset if you're out of work, but you are going to use toilet paper. And so that stock is very cheap right now relative to its history. So we've gone there. Or even like in banks, Bank of New York Mellon is a big trust bank and has over $1 trillion in their asset management firm. It is a mid-cap stock, but it is a very low-risk company within the financial sector that we are finding attractive.
Yeah, so it's interesting. It's not the companies that are in the big headlines, but they are just solid performers for you, it sounds like.
Yes, yes.
Yeah, yeah. So you mentioned artificial intelligence, AI. Um, People are now starting to worry that there's some kind of a bubble building up there. And people who've been investors for a long time, they remember the tech bubble years ago.
Yeah, I think we are equating it. There's a lot of similarities and a few differences, but the similarities are that a lot. So go back to '99, and I mentioned I'm bald and have a gray beard. So I was around then. Um, the internet is everything we thought it was going to be 25 years ago. We're able to get on it, probably even more so. We're able to access the internet by our phone, pay our bills, everything else. However, valuation started incorporating a belief in high degrees of growth in the short term. And while that growth has materialized, it's been over a 25-year period. Much the way the internet was kind of a new idea in 2000, AI is a new idea that will be an economic force for the foreseeable future, next 20, 25 years or so. However, a lot of the assumptions around growth and a lot of assumptions about the investments in AI are getting very aggressive. Right now, about $5.2 trillion, and that's with a T. These numbers are getting astronomical and out of hand, is set to be invested by the hyperscalers, Microsoft, Amazon, Google, into AI. As of yet, we're not seeing a high degree of return. So the companies aren't making a whole lot of money out of AI. And we think those assumptions are very, very aggressive. So as opposed to making a bet in these areas of the market that are very expensive, maybe have high potential growth in the future, we are finding areas of the market where we don't have to make those assumptions. And I mentioned consumer staples companies, but we have railroads, Norfolk Southern, we have healthcare companies, we have utilities, paying us a stable dividend. So we're really set up in portfolios to be a ballast, to provide dividend yield, provide downside protection. There are areas of your portfolio that are more growth oriented, but as value investors, we're going to skate our lane and provide that low risk return profile that you've hired us to do.
Mm-hmm. Yeah, so can you talk specifically about Oracle? They've been in the news recently with some announcements of big business going on. What's your take on that?
So Oracle, in the third quarter of this year, announced an increase of orders, and I'm going to talk about these big numbers again, of $300 billion. So their orders went from 125 billion roughly to 425 billion. So market looked at that and said, oh, that's great. Big orders for Oracle means big future earnings. But when you looked at the underlying, so we're doing deep analysis, when you looked at the underlying order that caused that, it's from OpenAI, the company that does Chat GPT. OpenAI currently has about 13 billion in revenues. That's 1-3. And they made an order over the next 5 years for $300 billion worth of Oracle services. So you would have to say that company has to grow to about 200 billion in revenue, which is, let's call it 15 times, 16 times their current revenue over the next 5 years, just to pay for this order in year 5. And so when I'm talking about these aggressive assumptions, Oracle stock went up 35%. We said this is not really something we think is going to happen. It may happen, but we're not giving them credit for it. And what's happened since then is Oracle stock has come back down. The market has kind of come to us and said, maybe this is a little aggressive.
Yeah, the market figures it out eventually, doesn't it? And I think it is also making the case for being careful not to have everything invested in that one company that just seems to be doing really well right now. We're glad that we have you and your team to figure that out so that we get the right companies for long-term growth for our investors. So we've talked a lot about what's going on now, but what about if you look just a little bit into the future? What might we see happening there?
Yeah, so prognostication as a science is an inexact one, so I don't know. I think there's an old joke from years ago. Einstein goes to heaven and asks people while he's in the waiting room what their IQ is, and talks to the high IQ guy with about you science, and he talks to the middle IQ guy about politics and religion, and then the last person he runs into wasn't very smart and had low IQ, and Einstein said to him, "What do you think about the market?" So maybe it's an inexact science and maybe not done best by those who know the most. I say that to say, what we do, we know works over time. Buy good businesses that generate good financial returns, good earnings, and buy them while they're cheap. And that goes in and out of favor. There are a lot of things out there based on the risks we've already talked about that I think would benefit us in the future. Weakening consumer, everything else. That plays into our risk awareness. But in essence, we are set up to zig when the market zags or when growth stocks zag. And you mentioned diversification. Diversification is merely just buying different types of assets so that when something is doing poorly, something else may do better. And that's really all we're set up to do, is provide you a ballast relative equity investment. So we're going to go up over time. We've outperformed the market, but we've done so with substantially less risk. And by virtue of that, we're just going to continue doing it. As I mentioned, we're seeing healthcare stocks like Zimmer trading at 25-year lows. So the valuation of Zimmer relative to the market has never been this cheap, 8 times earnings. And this is a high quality company with secular tailwinds. We have an aging society that is going to need their products, hips, knees, and spines to live in a healthy fashion on an ongoing basis. But that's really where we're posturing the portfolio. And our outlook is these economies have solid fundamentals and can go up regardless of what happens in the economy or the market.
Mm-hmm. And thank you, Peter, for reminding us that there is a well-known successful approach to investing. It's not all speculation and just flying by the seat of your pants kind of thing. And I appreciate you joining us today and sharing your insights.
Thank you very much for having me, and we appreciate your conviction in us and the allocation to your client portfolios. We know that comes with a lot of responsibility, and we take that seriously.
Yeah, and thank you everyone for joining us. If you have any questions, feel free to reach out to Elevation. Otherwise, our next market update will be January, kick off the new year. Thank you for joining us.